Alarm, alarm, the world is going under. The next global financial crisis is gonna come. All the banks will fail tomorrow. Yes, I don't like those kinds of videos either. There are some concerning points though. A premium member in Telegram showed me something that's not that nice. Have a look at this table over here. It shows the insider trading behavior of top bank executives. And it shows how those sales developed over time. We've got Morgan Stanley, we've got JP Morgan, and we've got Goldman Sachs. And look how the sales, especially for Morgan Stanley executives, went up massively. This is a chart from 2006 to 2023. So 17 years of data. James Gorman is selling, Daniel Pinto is selling, Ted Pick is selling, Eric Grossman and Dan Simkowitz as well. All of the Morgan Stanley executives at all-time highs for their own stock sales. Now, why is that problematic? A few insiders in a bank are selling stock. The issue is that the market isn't that pricing in yet. This is JP Morgan stock relative to the S&P 500. So we're dividing here JPM by SPX. And we can zoom out a little further. Long-term banks do not outperform the rest of the market. Surprise, surprise. And if we don't look at US dollar prices, we simply just look at relative valuations. We have been relatively stable in the last 20 years or so. So why are JP Morgan executives selling? This here, by the way, is Morgan Stanley relative to the S&P 500. And this is a chart we don't want to see too often. This is Silicon Valley Bank divided by the S&P 500. Now, some people didn't yet understand why this actually happened. And I want to show you why. It happened because interest rates rise. And as a consequence of rising interest rates, long-term government bonds fall in price, more than 50% minus for SPTL. This is a long-term government bond ETF. Now, some people that aren't that close to finance might not understand what's going on here, so I try to explain this as simply as possible. When you buy a bond, you get every year coupon payments. At the end of your duration, you get the principal plus coupon. So you're buying a security by the government with fixed interest payments. Now, when the Federal Reserve rises interest rates, that means you can now buy a bond that pays more coupon. But the bonds you're currently holding still pay the old coupon. And so you've got a direct loss, relatively speaking, right? If you had invested your $100 not 2 years ago, but today you'd be better off, you'd get more coupon. Now, there's a mathematical way to actually find out why the prices of bonds go down that much. By the way, you still get your bond payments, right? This is simply just if you were to sell your bonds. The value of your bonds drop, but the guaranteed payments are the same. The value of long-term bonds drops so much because there's something called discounting, cash flow discounting. Here's the problem with crypto YouTube. People promoting becoming degen or buying 100x coins. That's what gives clicks, but that's not what's going to bring you forward. I refuse to take money from centralized exchanges. I refuse to take money from crypto projects. I refuse to pump and dump a coin and filling up my pockets in the background. I don't do any of this. Instead, I share my knowledge in the form of tutorials in the premium membership. So that's content that won't do well on YouTube, but that builds up skill over time. You can also directly contact me over there. You can directly pick my brain. Feel free to check it out. TheBitcoinStrategy.com is the link. $1 today is worth more to you than $1, say, 10 years in the future. Right? First of all, because $1 is worth more, there's less inflation, but also simply just for the time preference. You rather have the money now than in 10 years. So you have to discount the cash flows you get in the future. And the further out that cash flow in the future is, if it's 20 or 30 years away, you have to discount it even more. And you discount it by something called the discount rate. Now, there's all kinds of different factors in the discount rate, usually, right? There's sometimes even the risk. Do you actually get paid? So you have to add more to the discount. There's also a potential growth rate that might offset the discount. That's especially important for stocks. For bonds, things are relatively simple. It's simply the risk-free rate. So currently, with 5.5% interest rate, you have to discount the future cash flows, say 20 years in the future, by 1.055 to the power of 20. Now let's actually make that calculation. 1.055 to the power of 20. What's a cash flow discount rate for a dollar that comes in 20 years? It's 2.92. So you need roughly 3 times the dollar promised 20 years out in the future to purchase it with $1 today. And so your fixed promised bond payments, they go down by 1 divided by 2.92 if interest rates rise by 5.5% and if your bond duration is 20 years, right? If it expires in 20 years. There's a bit more complexity to it, right? You have to actually discount every single cash flow. The majority of the cash flow comes at the very end with the principal. I don't want to bore you too much with academics here. I want to actually go to the essence of this video. Why is this a problem for banks? And why did we see this crash in Silicon Valley Bank? The issue is banks have on the one hand liabilities. That's your deposits, right? You deposit, say, $1 million in a bank, and the bank has the liability to pay this back to you. So they've got short-term liabilities. Whenever you ask them for the $1 million back, you should receive that $1 million back minus the terms and conditions they have, like maximum payouts or whatever, right? But they've got short-term liabilities. Now, banks want to make money. So what do? Once they receive the money, they invest it. And what's the safest investment? It's government bonds. And what gives you more return? It's long-term government bonds typically. And so here comes the issue. Interest rates rise, the value of your bonds fall because of the discounting. You need to pay that customer tomorrow. He asked for the $1 million, but you don't have it because the $1 million that you invested went down in 50% in value. Or even by more than that, right? If it's a 20-year bond, by 66% roughly, right? As we figured out. And so that's how banks get in trouble. And so maybe those bank executives see things that we don't see. Maybe hidden in the balance sheet somewhere, maybe not just with plain government bonds, but maybe more complicated with all kinds of derivative contracts. There is duration risk in the assets. And that duration risk, right? Bond duration risk, that might not yet be fully accounted for. There's also other questions, right? Can property still rise? Because that's also a big thing for many banks. They hold property, or at least they've got property as insurance that they can potentially sell off if the person can't serve the mortgage. So yeah, I'm not a bank executive and I don't have a crystal ball. I cannot foresee the next financial crisis, but I can see what the smart money is doing, the people that do know what's going on. And it doesn't look pretty. Heightened interest rates puts a lot of pressure on many companies, especially on banks. And so the minimum learning we should take from this is probably not to buy JP Morgan stock right now. No financial advice, right? But when the most knowledgeable people in the company sell, why should we buy? I don't have the audacity to believe that I can estimate where JP Morgan stock will go better than the CEO or the senior management at least. If you found this useful, please give this a like. Thank you. It will help the channel grow.